Hello, everyone. Welcome to our first US Outlook webinar of 2020, presented to you by PhillipCapital. My name is Roger, and Mingjin is here with me. Thank you so much for joining us. Happy Chinese New Year to all our valued clients as well. We are pleased to have you here with us today. Okay, we will start by reviewing some of the macroeconomic events that have happened recently, which are mainly the easing of the Iranian tensions and the signing of the US-China Phase 1 trade deal. With the markets hitting higher highs and the markets in a bull run phase for a decade now, some investors are asking if a recession will be around the corner. And if a recession were to start, what will trigger it? Let us share with you a catalyst that, if it is present, will result in a recession. We will show you data from the last 3 recessions and how this catalyst played a major role. We will next share some ETF ideas that will complement our trading ideas, and after which my colleague Mingjin will be sharing some technical analysis. The webinar will then end with a Q&A session. During the webinar, if you have any questions, please do feel free to use the Q&A function, which can be found at the bottom of the screen. You can type in your questions during the webinar. However, we will only reply at the end of the session. So without further ado, let's get started. On January the 3rd, in a pre-dawn air raid at Iraq's airport in Baghdad, the US struck and killed Qasem Soleimani, the head of Iran's elite Kurd force. Iran vowed harsh retaliation. In a tweet the next day, Trump threatened to hit 52 Iranian sites very hard if Iran attacked any US assets. Iran on January the 5th said it will no longer abide by the enrichment limits in its 2015 nuclear deal with world powers. The next few days saw heated rhetoric between President Trump and the Iranian President Hassan Rouhani. So in the early hours of January the 8th, Iran launched a series of missile attacks at 2 Iraqi bases housing US troops. The Iraqi military said in a statement that 22 missiles were launched on the 2 sites. In a tweet, Zarif said Iran had taken and concluded proportionate measures in self-defense. In Washington, Trump said in a tweet that an assessment of casualties and assessment and damage from the strikes was underway and that all is well. Later, Trump said the Iranian missile strikes on bases in Iraq did not harm any US troops stationed there and damage was minimal. An outcome, he said, showed Tehran wanted to de-escalate the standoff. Tensions went away and we saw a relief rally in the markets. After months of threats to impose tariffs on China for its alleged unfair trade practices, US President Donald Trump finally followed through and imposed tariffs on Chinese goods on July 2018. Over the next 18 months, the 2 countries engaged in countless back and forth negotiations, a tit-for-tat tariff war, introduced technology restrictions on each other, which almost resulted in a full-blown trade war. Prior to the Phase 1 deal, the US had slapped tariffs on US dollars 550 billion worth of Chinese products. China, in turn, had set tariffs on US $185 billion worth of US goods. For many months, neither Trump nor China's President Xi Jinping showed signs of wanting to back down. But finally, on January the 15th, 2020, the first signs of truce were seen when the 2 sides signed a Phase 1 deal, which officially agreed to rollback of tariffs, the expansion of trade purchases, and renewed commitments on intellectual property, technology transfer, and currency practices. Details on specific product purchases in each of the categories was, however, not released, as both sides feel such disclosure would risk distorting markets. Trump also said that at a later date, he will be headed to Beijing for negotiations on Phase 2 of the deal. Now, the easing of the Iranian tensions is to produce a rally in the markets. The Wuhan virus, which originated from the Huanan seafood market last December has several countries now confirming cases. There are about 6,000 confirmed cases with 132 deaths so far, and there are 7 cases confirmed in Singapore. Financial markets around the world have been rattled by the outbreak. Amid growing concern over the spread of the virus, China has put Wuhan and several other cities on lockdown. The drastic measures spooked investors across Asia who dumped shares of restaurants, cinemas, casinos, airlines, and scrambled for safety in bonds. Oil fell to its lowest price in 7 weeks, reflecting worry that demand will slump if the Wuhan virus undermines China's economic growth. Gold price increased at the same time. Now, even with the positive macroeconomic events like the easing of the Iranian tensions and the signing of the US-China trade deal, recessionary fears still linger in the minds of many investors, especially with the worsening of the Wuhan outbreak. Many are also asking about the sustainability of a market rally that has gone on for a decade. Prior to the signing of the deal, there was a lot of uncertainty with the US-China trade war, which disrupted many businesses. Now, the negative events, as mentioned, can lower corporate profitability, no doubt. But what we need to understand is that slowing profits on its own will not start a recession. We had previously mentioned in one of our past webinars that when an inverted yield curve happens, it is a very reliable way to predict a recession. But that by itself will not start a recession as well. So what will start a recession? A particular catalyst needs to be present in order for recessions to start. The catalyst is when debtors are no longer able to refinance their debt as they come due. This is the catalyst, the lack of refinancing. It is the lack of credit availability that will start a recession and a bear market. According to Valence Research, every major recession of the past 150 years had always started with a debt crisis. Companies have 2 options to service debt as they come due. They can either pay off the debt with their cash balance and cash flows, or they can refinance their debt with more debt as they come due. In other words, to roll over the debt. And as mentioned, debt crisis usually begins when companies are unable to refinance their debt. They are still required to pay, but they don't have the cash to do so, and the banks are not willing to lend to them. It is thus essential that we monitor credit standards to determine the health of the markets. When lending standards become excessively strict, debtors cannot refinance their debt, a recession will follow. One good way to determine the level of credit tightening is to monitor the Federal Reserve's Senior Loan Officer Opinion Survey. As shown on the screen, this is a survey of nearly 100 US banks on their lending trends and asks them to rank their lending activity over the past quarter. From this chart, we can see the latest credit tightening standards of the banks in the last quarter of 2019. The blue line that you see represents the percentage of the banks tightening their credit, while the shaded portions show the recessions of 1990, 2001, and 2008. As you can see, there is a strong relationship between high levels of tightening, credit tightening, and a recession. Each of the last 3 recessions covered in the chart were preceded by more than 50% of US banks tightening their credit standards. Looking at today's results, we can see that credit standards tightened slightly in the last quarter of 2019, but only by about 5.4%. This is indicated by the arrow at the end of the chart. One might think that this should give investors a reason for pause, but in reality, this only means that banks are just starting to tighten. Current lending standards are still very reasonable. While we may be approaching a potential recessionary window, there's no immediate cause for panic. An inverted yield curve by itself will not send us into a recession. It is simply an indicator that we need to pay greater attention to signals in the credit and equity markets. As long as lending standards remain fairly relaxed and the credit do not become an issue, a recession will not be immediately around the corner. When it becomes tough to find access to credit is when we need to be concerned. Clearly, we are far from the issue right now. This is yet another reason why we remain positive in the coming quarters. As the US indices continue to march higher, there is one particular sector that is breaking out right now. It was one of the biggest winners during the rally in late 90s. This sector is breaking out once again. It recently hit a new 52-week high, and history says that this breakout should lead to more gains as the rally continues. We are talking about the biotechnology sector. And while technology stocks jumped about 200% in the final 18 months of the 1990s boom, biotech stocks totally crushed their return. Clients who are interested can look at IBB, okay, as shown here, the first ticker. It tracks the Nasdaq Biotech Index and total assets of $7.46 billion. With the recent easing of the Iranian tension, investors who believe that oil prices will continue to go lower can look at SCO. This ETF shorts the crude oil index, and as prices go lower, the ETF will rise in price. This is shown as the second ticker, SCO, the inverse of the Bloomberg crude oil sub-index. And currently, its total assets is $103.67 million. Investors who want to take advantage of the rally in the general market, such as the S&P index, can look at SPY. This is shown as the last ticker, SPY. It tracks the S&P 500 index, and its total assets is $317.37 billion. Please do note that leverage ETFs are not suitable for beginners and retail investors, as the loss will be magnified. Furthermore, leverage ETFs are not meant to be held long-term, as the daily rebalancing will cause the value of the investment to erode over time. Okay, we will now start a poll for our viewers. Please do take some time to read through and to take part in the poll. Thank you.
Okay, so now I'm Ming Jun here. So I'll be going through with you the technical analysis in the next portion. But before that, I'll be running through with you some exciting new features of the Poems platform and promotions that you need to be aware of. Actually, it's very beneficial for our clients. Okay, so let's take a look next. Okay, so just in January this year, we have launched this new account called a Cash Plus account. Okay, it's the lower cost, it's the account that provides you the low cost trading. Okay, so all custody accounts, namely your prepaid custodian margin accounts, are eligible for conversion to a cash point. You do not need to actually open a new account. You just need to convert your existing account to this account. Okay, do note that the prepaid account, the current brokerage is back to the previous charges of $20 flat, whereas this new Cash Plus account is actually providing you with even lower brokerage of up to $6.88 flat. And of course, for more information, please do just visit this website over here. You can find out a lot of information, or all the necessary information are there. And if you still need further assistance, please do contact your trading representative for them to advise you further. But this definitely will be a good way for you to trade the US markets, a cheaper option for you to trade the US markets. Okay, the new Cash Plus account basically is like a cash prepaid account, but it has a standby margin facility for you to actually leverage on, to use your existing cash and stocks on hand to leverage on it and get on with the margin facilities and buy, leverage. Okay, so without further ado, I will just go ahead to share with you on some technical analysis on the charts on Poems. Okay, let me just switch the screen. Okay, for the clients here tuning in, so right now you can see that this is our Poems platform. I'll be going under the prices LP1. And under my watch list today, I'll be sharing with you 4 counters. Okay, one of which is the S&P ETF that Roger just now actually mentioned on SPY. I will also be sharing with you 2 of the hottest stock, higher volume traded counters that investors are looking to trade, and also the movement of oil prices. Okay, so first let me just show you on the S&P 500 chart. Okay, so this is our S&P 500 chart. Okay, in technical analysis, I will always like to do a long-term perspective followed by zooming into the near term. And for the past 5 years, right, what you can see here is that generally S&P has been on a very strong uptrend, and we can see some retracement here back in early 2019. Okay, but it has since had a very good strong bull run over the past year. Okay, so general trend is up, and for a trend to remain this strong, this long, it is quite difficult for it to turn down. Usually that's the case, as you can see from this chart over here. Okay, so let's zoom into 3 years. Okay, on my chart setup, I have the exponential moving averages and the RSI, which is your relative strength index, and also the volume traded. Okay, give me a moment, let the chart load. Okay. The 3-yearly chart shows that initially the higher highs are forming much later. So investors would have thought that this may have been the peak. And of course, it was not the case. In fact, when it first broke, we can see that there is immediately a higher high over here. Okay. So for an uptrend to remain intact, right, a higher high must form and a higher low must form. Okay, this was a particular instance of oversold situation from your RSI. You can see here that it was pretty oversold here and would have presented a good buying opportunity. And another one would be here where the RSI just touches the 30% oversold indicator. And of course, now we are here. For the past 2 days, due to the virus that is happening in China, we can see some short-term volatility. Okay, but you can see, let's zoom in even further here. Just over the past quarter from October last year, okay, the chart is actually just quite it's just hovering above your moving average. I think that is a 20 period moving average. Okay, just had a very strong sell off, but immediately there is a big buy up movement over here. Okay, so near term wise, we can expect volatility to come in, and the effects of the virus may not be immediately formed in the market. So it takes time for people to get to push the price around, for the bulls and the bears to fight it out. So I believe right now it will take some time before this high gets broken through again. But we have earnings seasons coming in again. Apple's releases their results, so this may also be a determining factor on how the market moves in the near future. Okay, that's for this. Next, I'll be sharing on the oil prices. Just give me a moment, I get the chart back up. Okay, so for the oil prices, again, let's zoom out. Okay, 5 years, this one is USO, also ETF in US, tracking the oil index. Generally, for the oil, the range is not that huge as compared. You can see the S&P, right, it's 180 for the 5 years chart, 180 all the way until 330 over. But this one, we are talking about a smaller range, okay? The long-term wise, I'm not going to talk about it. I'm going to zoom in into the shorter term period from just over the last year. you can see that there is actually a range forming from June onwards. Okay, so this part here, we can see that there is a good support over here, 3 points touching, triple support, and likely we're going to have, I mean, it will likely stay as a very strong support area, which is the 1070 region. Okay, and of course the top end, we are looking at 13 US dollars for the resistance. Okay, so it touched here once back in September, and also just the mid of this month. Okay, but this one, as we know, as the virus came, this plays out. Okay, so a huge sell-off, RSI is showing oversold situation, so potentially we may see a short-term rebound and tracking back to the moving average line. So but this downtrend, I mean this short-term downtrend may not be that conclusive, but what we can see here is that this is range bound for the past more than half a year. It's going to be, it has stayed in within this range of about 1070 to 13 US dollars, and we are looking, of course, to try to enter near the support region and exit at the resistance. Okay, that's for the USO. And next, I'll be sharing with you Tesla. Okay, so for Tesla, let me see. Okay, this is the Tesla chart. Okay, again, let's zoom out again. All my charts are the same. It's always going to be RSI volume and the moving averages. Okay, I drew this line is for the resistance that over the past 3 to 4 years, right? The resistance has been around this price level, 378 to not even crossing 400. But just the past 2 quarters alone, you can see a huge movement. Okay, so basically this happened when they posted earnings for the first time instead of the losses expected. That's why it jumped. Okay, for investors, do take note that Tesla market cap is actually right now second for automobile manufacturer, behind Toyota only. Okay, surpassing also Volkswagen, but their production is only a fraction of what Volkswagen is producing. So this counter, right, is really quite sentiment based. Okay, and for the past since October, late October, it has been on a very good uptrend, very strong uptrend. The price has almost doubled just over the past 1.5 quarters. Sorry, yeah, in fact, just 1 quarter. It has almost doubled in price. I'm sorry, I got locked out. Let me just re-logged in again. Let me just pull out the chart again. Give me a moment. Okay, back to Tesla that I was sharing, right? So the past quarter has a huge strong run. RSI is of course staying at above at the overbought situation, as we can expect. But I mean, there's a huge risk in going against this trend. This trend is very strong, and I mean, analysts have been raising their price targets, which also affects the price movement of the chart. Okay, but in near term, right, prices should at least fall back to the first moving averages. Okay, if I mean, this moving average may not be that strong, but what you can expect is there may be a chance where it may fall back to the resistance, the previous resistance level, about 380 US dollars. I mean, if that happens, I believe that would be actually the better way, a better entry level. Right now here, it's a bit risky because this counter, as you can see, is really quite volatile. The range can be $50 over in just a couple of days. and thus investors must take note of it. Okay, the last one that I'll be sharing with you will be on Beyond Meat, also a heavily traded stock over the past a couple of months. Okay, so Beyond Meat does not have a very long history. Only listed, let me see, last year. Yeah, last year. Okay, of course, it had a very good bull run over then, back all the way to 230. But let's take a look at the shorter term period. Okay, volume here picking up. Okay, let's take a look at the hourly chart. 20 days hourly chart. Okay, for intraday trader, this is actually a pretty interesting chart over here. Okay, what I can see very clearly is that there seems to be some sort of support at about the 117 price region. You can see the price didn't fall below it. Anything from 117 to 120 may present a good buying opportunity. Okay, and of course, this is over the past week itself. Okay, right before Chinese New Year, over the past few days. Okay, and even with the virus, it is not really moving that much, and as in not moving that much, as in not because of the reason of the virus itself. Okay, next will be, we are looking at the resistance area. Okay, this is likely going to be the short-term resistance. Okay, at about the 1-3. Let me just take a look at that. Yeah, about the 135, 133 level. 133 level is where the resistance is going to set in. Okay, but it may take some it may take some time to eventually reach there. Okay, so short-term traders may look at this price entry level to consider to take this trade in the long. I mean, it is still very news driven, so for investor to actually you have to do your homework very well and understand what is this company actually doing before deciding to invest. Of course, short-term ideas would be to long at about the 117 region and exit near the resistance at this point. Okay, with that, I have come to the end of the technical analysis part, and we will be proceeding on with the Q&A session. Okay, first of all, let me just answer some quick questions on the Cash Plus account. Okay, so right now, the 6.88 US dollar, of course, there is a condition to it, how you can achieve that. Yes, this is the brokerage moving forward, and you just have to refer to the website in the screen that you can see here, or just log on to Poems. It is right there on the front page. You can actually just see what is the criteria to get this 688 flat US dollar brokerage. Okay, so I was mentioning also that this Cash Plus account has a standby margin facility, so you can use your cash inside as a source of leverage to leverage on your position, increase your position sizing. Yes, and the interest can also be found inside the link provided on the screen. So just please do refer to the link to find out more. Okay, so there's also a question on how can you check whether your account is being converted to the Cash Plus account. Yeah, please do call your trading rep to ask them to check for you during the working hours. Right now, I'm not able to advise whether the account is being converted. Okay. So the promotion that we had previously was for the cash prepaid account, which is over here, the prepaid, the CC account. But that promotion has already ended. So right now, this account is the one that has the low brokerage for US trading. Okay. So with that, I'll pass on to Roger some other questions that he will be answering on. Okay, so there's a question on what are some stocks that we can invest in during this Wuhan virus period. Yep, Roger, what's your view?
Okay, we believe the ETFs, SBIO and IBB should do well. These are biotechnology stocks in line with the general market rally and the fact that the Wuhan virus is causing a lot of concern. There will be some upside to the biotechnology sector.
So the next question is, what's your view on the S&P ETF? Is there any buying opportunities, or even can you consider China ETF?
China ETF. If you're willing to hold for a very long term, there'll always be upside to it. But in the meantime, short-term wise, there'll be a lot of volatility. As for the US ETF S&P, as I mentioned earlier, we don't see any credit tightening at this point that will restrict growth or that will even cause a recession. So for the next few months, we do believe that the S&P will continue to rally, even with the viral outbreak. The rally will still continue because the credit.
Okay, so there's also a question on whether would there be a rate cut for tonight's FOMC meeting. Okay, so there is actually a FOMC meeting tonight, but based on consensus, we are not expecting a rate cut. It should hover at about the 1.75% region. So that's for the rate cut. So the next question that we have here, we'll probably answer another two to three questions. Okay, so the next one that we have here is how do you know when there is a credit tightening? Yeah, Roger.
Okay, if I can get to the slide I showed earlier. That's right. Yeah, the next one, the one. That's right. Yeah, if you were to look at this slide, this is actually the Senior Loan Officer Opinion Survey. So this is actually a survey of 100 US banks, to ask them, what has their credit practice been? Have they started tightening, or have they remained? Has the credit remained loose and relaxed? So if you are able to look at this, and if more than 40 or 50% of the banks come back and tell you that they are indeed tightening credit, then you know that the general credit is tightening, and that's where you need to be more aware.
Okay, one last question that we have here. Let me just take a look. Okay, so I mean, investors may be finding information to trade the US stocks, right? Such as company info and fundamentals. So where can you actually find it? Okay, right here. Okay, first of all, you can take a look at the slide here, right? For educational sources, you can look into these links that is provided by Poems. We have market journals and also our research reports from our research analysts under the stocksdmb.com. You can find more information there. Alternatively, you can head to our Poems platform. Let me just share with you on the Poems platform. Okay, so this is the Poems platform. Where can you find more information for Tesla, for example? You just have to right click on Tesla. There is this stock analytics which you can click on. Okay, and it will give you another page here. Okay, this is the stock analytics where you can find some of the fundamental information on the counter itself. Okay, can see that the consensus target price back up to date is actually 378, but that is because it has not been updated by the analyst. So the price movement is so much faster than how they can analyze where is the stock going to move. Okay, so you can take a look at the consensus target price. There's also the past annual summarized financial statement over here, your competitors analysis, who is the management. Yeah, all this information is brief, but also concise information that can help in understanding the company itself. So this data is supplied by Thomson Reuters, and you can find it under our platform. Okay, so with that, we have actually come to the end of the webinar. Okay, you can still contact us at the number here provided in the screen, and also drop us an email if you have further queries. Okay, this webinar is actually conducted monthly at the last month, every month end on a Wednesday at 8:30 p.m. So if you can, please do sign up and look out for the information provided by your trading rep. We should be sending out invitations for you to sign up for the next webinar in the coming month. And we hope to see you in our upcoming webinar in February to get more information and also our updates to our clients on how the markets are actually doing for the US. Okay.